Hey folks, welcome back to Ripe for Investing. I know I've been doing some shorts showing you what the consumer staples and utility sectors have been looking like in relation to the S&P 500, but I'm going to drill down a bit more and look at some individual stocks and just kind of show you some charts. So consumer staples in particular is looking basically pretty bad. Most of these names, they have not been this out of favor since 1999 to 2000. I just bought this stock, Smuckers, to reduce the volatility in my own portfolio. And it actually, in comparison to the S&P 500, it hasn't been this low since basically 1997. Pepsi hasn't been this out of favor since fall of 2000. And before then, 1998. So basically what I'm doing is I'm looking at the stock over the S&P 500. That's what I mean. Campbell's Soup has never been this out of favor. General Mills, if you take out January 2022, it's basically haven't been this out of favor since the fall of 2000. Unilever, same thing, fall of 2000. Your tobacco stocks like Philip Morris and one that I'm holding, BTI, British Tobacco, they've never been this out of favor. Now, one could argue that, hey, less people are smoking and all that, but check out these charts. I mean, they've been this out of favor once before, and you're going to notice that the overwhelming theme that I keep mentioning, what year? 2000, 1999. And just real quick, it's frankly looking a lot like that year. If you go back, the Fed's interest rates were about 5.5%. Right now, they're about 5.33%. So even the interest rates are kind of looking like they did back then, which is kind of scary. Taking a look at some precious metals. Gold, if you take out January 2022, it's not been this low since 2005 in comparison to the S&P 500. And if you look at the chart, this is usually followed by some serious outperformance. SLV silver has never been this low in comparison to the S&P 500. And it goes all the way, the ETF goes all the way back to 2006. So we're looking at some pretty interesting stuff. If you do look at, utilities, Duke Energy, never been this out of favor. Southern Company, not since like 2001. Exelon, not since 1998. So we've got a lot of these companies that have never been this out of favor since the year 2000. And that's about what the interest rates are looking like once again. I think consumer staples are having some issues due to a number of reasons. People keep talking about weight loss drugs. I won't get into that, but I think those weight loss drugs are going to end up being some bad stuff as far as I'm concerned. But I think what's really happening with these consumer staple stocks is that consumers are starting to push back. If I go to the grocery store, I'm starting to see the freezers full of Tyson's chicken because people don't want to pay that much money. The cereal aisle is full. Nobody's going to pay $8 for some Raisin Bran. And my local Kroger, they're starting to run sales on these cereals because people are just starting to say, no, we're not going to pay it. And that's pretty much what they should have been doing all this time. Another thing I'm going to show you is XLP, which is the consumer staple ETF, versus IYW, which is the tech ETF. If you look at this ratio, they've never been this out of favor. There's even some industrial and material stocks that are seriously out of favor that might be up for some big outperformance if you look in the right places. Overall, I think that this tech stuff has just gotten a little too big for its britches. I don't think we're going to have a tech bubble like we did in 2000, but I don't think it's going to end well for these people that just keep piling into QQQ or TQQQ or IYW like I was in. I sold out at like a 70% gain, took some nice profits. It has went up more, so maybe I sold a little early, but I think in 2 or 3 years, we're going to see that some of this tech stuff is going to come crashing down, and we're going to see a broader market rally.